I'm a big free markets person. So philosophically, I believe in giving people choice and letting the market dictate what's popular, what's not. People have been saying this for 20 years, that we had too many, not just ETFs, but too many financial products. And on one hand, that may be true, but if it's true, then why do we keep seeing more and more demand?
Leveraged ETFs are seeing more and more use in today's stock market. In fact, we've now got single stock leveraged ETFs that give you 2x or 3x or minus 2x or whatever a single stock's daily return. These things have proponents and they have detractors. Are leveraged ETFs the way of the future? Are they the market's junk food? And despite the warnings in the package, should you hold them for more than a day? Here to unpack these questions is Will Rhind, CEO of GraniteShares, a big player in leveraged ETFs. Will, welcome.
Thank you, James. Thank you for having me.
All right, glad to have you here. So, as I'm sure you know, anyone Googling leveraged ETFs is going to see a bunch of different stuff. A Bloomberg article recently implied that they were like the living nightmare of Vanguard founder John Bogle. But then some other content I've seen has said you can actually make a lot of money in them. Before we get to that, though, I won't time you on this, but can you give me a 30-second rundown on GraniteShares as a business?
Yes, of course. So GraniteShares is first and foremost an ETF issuer, which means that we're an asset manager that specializes in the creation, the marketing, the distribution, the management of exchange-traded funds, or ETFs. So we started the business 7 years ago, headquartered in New York City, and have been lucky enough to grow the business and expand that globally, where we operate in Europe on major exchanges across Europe and distribution now into Asian markets as well. So the company manages somewhere between $7 and $8 billion on a daily basis and turns over, in terms of daily trading on our platform, somewhere in the region of $1 to $2.5 billion a day. So incredible amount of activity, incredible amount of interest. And a lot of that is down to these levered single stocks, which we're going to discuss.
How did you personally get into this space? I'm just curious.
So I personally got into it because I was out of college. I started as an investment bank graduate scheme at Nomura in London. And then after doing that for about a year and a half, I moved onto the buy side into an asset manager with Barclays Global Investors at the time, who were launching the first ETFs in Europe. And of course, that business, Barclays Global Investors, or BGI, was acquired by BlackRock in the financial crisis, and now everybody just knows it as BlackRock. But we were just doing the first ETFs really in the market before the product, the ETF, became an industry. And so I was lucky enough to get involved with it at the early stages and have followed it through my career.
You're quite a veteran, in fact. Your website, Will, says you have a passion for classic cars. I just have to ask, any favorites?
I think that when you think about favorites, one, I naturally sort of gravitate towards the British cars. However, it's really the 1950s, 1960s sort of classic, Ferraris that everybody knows and loves in the market. So a combination of those factors.
It's hard to dislike the Ferraris, right? Everybody loves them. All right, so tough question right from the start. How do you respond to the criticism that leverage ETFs are either the junk food of the investing world? I've seen the crack cocaine of the investing world. I've seen that, or some similar analogy. I've seen a bunch of them. A lot of people are making these comments. What do you say to that?
I say that probably all of it is true in some respect, and that like any kind of investment product is not for everybody. So with anything leveraged, you're introducing a higher level of risk. And the one thing that we'll talk about is leveraged ETFs are really more trading products. And so when it comes to trading, that's just a philosophical difference. Some people love to trade. Some people want nothing to do with trading. And with that are the associated sort of health warnings. And so just like if you look at options, there'll be people that love options. There'll be many people that tell you never, ever touch options. In the cryptocurrencies or small cap stocks, the market is sort of littered with people that will tell you to do one thing or not to do another. And with leveraged ETFs, the good news is they do what they say on the tin in terms of providing that return, whether it's 2x or minus 2x, the daily return of a given stock. But with anything that's leveraged, there's a higher level of risk because there's a potential for a higher level of reward. And so with that comes the fact that this is not a product for everybody.
A Bloomberg article, if I'm recalling, made, I think, a positive point based on what you're saying, that I forgot the leverage ETF it was talking about, but basically every 2 or 3 days they were turning everything over versus like 185 days for some, Vanguard type big market ETF. And that's a positive thing in that it signals that the users of that ETF are in fact trading them. What percent of your customers do you think get it in terms of they're in the right place, and what percent might be a little bit confused?
That's the interesting part, because there's nobody is our customer in the true sense of it, because people buy any kind of ETF from a broker. They don't buy from us or can't buy from us directly. So that's like sort of the nuance that ETF issuers can't really answer that question in terms of who the underlying customers are, or how exactly they use the product. So we have to almost sort of approximate by saying we think that the majority of people are trading the product, are using it for short periods of time, and are getting exposure, directional exposure, long and short, both for clearly profit maximization strategies as well as hedging strategies, and probably everything in the middle.
What would you would only hedge a day trading strategy with this? I'm just curious how they're used for hedges.
Yeah, so in terms of providing the short, we have 2x short. So if you were, let's say, coming into earnings and you were sensing some negative chatter about a particular stock, you maybe owned the underlying stock and you maybe owned it for some time, so let's say Nvidia. A lot of people, almost everybody who owns Nvidia, is sitting on embedded capital gains, and sometimes extremely large embedded capital gains. So if you sense there might be some volatility in the stock, you don't necessarily want to sell the stock and trigger that capital gain, but you might be interested in hedging that position against a fall, a temporary fall in stock price. And so using a short product, a leveraged short product, is a way to think about doing that.
Probably the most core criticism, if you will, or at least thing that is needs to be explained in the SEC's mind. The SEC has put out some various communications about leveraged ETFs over the years, is simply that they're usually designed to give some variation of a daily return of a stock, either 3x, 2x, minus 2x, whatever it is. And that can vary massively from the long-term return. So in other words, if you hold it, and a Bloomberg piece, I think it was the same one, mentioned that they used an illustration of your 3x daily micro strategy exchange traded product, but it was just kind of picking that fund. It was not singling you guys out, but it was saying that while MicroStrategy itself is higher by more than 100% this year, LMI3 has dropped nearly 82%. And I made the point in an article I wrote that that's actually according to plan, in the sense that the math, a few other reasons, but the math itself is such that it's very path dependent. If you have a 50% drop, you need 100% gain to recover, for example. And it's hard to generalize what's going to happen in the long run based on what happens in the short run. The question I want to ask, because there's a whole subculture that I found, Will, when I was researching this article, of people who actually do violate the warning on the package and hold these things for a long term. And they work against you if the asset is flat. They certainly work against you if the asset is going down. But if you have something like a long-term S&P 500 index fund, maybe leveraged 2x or 3x, some of the returns you can get, at least on paper, have been phenomenal by holding for the long run. Now, you would have massive, massive gyrations along the way. I guess my question is, what do you think about that? Have we overly maligned leveraged ETFs as a long-term investment vehicle?
Yes, but I think we've done it for a good reason. And that is because the two words you mentioned, path dependent or path dependency. And path dependency requires a crystal ball. And none of us have a crystal ball in terms of how a stock will perform in the future, and particularly its performance on a day-to-day basis, going forward 365 days, 2 years, 3 years, whatever. And it's that path dependency that matters. It's not the linear return. So in other words, it's not what the stock ends up doing. In other words, its final price in a year's time, in 2 years, 3 years. It's how it got there, which matters. And so the way that path dependency works is that we provide constant leverage. That's the benefit of the product. Whenever you buy it, doesn't matter whether you buy it today, whether you buy it 6 months from now, a year from now, it's constant leverage. So you get 2x or whatever the stated leverage factor on the packet is. And you can only do that by rebalancing the portfolio, resetting the leverage every day. And that would be in contrast to a product that didn't set or rebalance its leverage. And therefore, if you had a product that rebalanced on a monthly basis, for example, on day one, you would have the stated leverage factor on the packet of 2x. But if you bought a week into it, maybe 2 weeks into it, you would almost certainly have either more leverage or less leverage. In other words, you wouldn't have that constant leverage. Now, the effect of doing the resetting or the rebalancing every day is that you introduce, therefore, a path dependency, a compounding of returns, because it's not just about the 2x return on the day. You're then reinvesting, let's say, the profits if the underlying stock goes up, and then you're applying 2x on top of that total return for the day. So you're starting off at a higher position than the equivalent linear return. And so over time, that compounding effect can either be positive and lead to an outperformance of the linear return, which is what you're referring to in terms of papers, academic papers like Leverage for the Long Run, etc., that are out there. Or it can lead to dramatic underperformance, clearly, if the stock goes the other way and goes down over time. Or, as you were referring to, in choppy market conditions, which is where you get an erosion of the NAV because you're going down and up, and this idea that if the market drops by 50%, it doesn't need to recover by 50% to break even. It has to recover by 100%.
Yeah. And there's also a buy high, sell low effect, right? Like
exactly.
it needs to own a certain ratio of the stock, and if stock goes up, that's kind of good, but then you got to buy more at a high price, and then you got to sell when it drops down.
Exactly right. So the biggest takeaway is that it's not a linear return; it's a path-dependent return, and the product does exactly what it says on the tin, which provides that 2x or minus 2x, whatever it is, on a daily basis. But because it's a path-dependent return, people look at the performance of, say, the 2x, whatever it may be, 2x Nvidia against Nvidia over a 6-month basis. That's either going to outperform the 2x linear return on Nvidia or underperform, but it almost certainly won't be the same.
I forgot how many millions of investors there are in the US market, or at least active investors, not just people who have a 401k at work and never really think about it much. What percent of them do you think are potential leveraged ETF customers?
I think in the grand scheme of things, it's probably still quite a small number, but we are interested clearly in the community of investors that love trading and love to be active. And I do think that in a sense, that community is getting larger because of the trend in self-directed investing. That whether people are trading every day, I mean, clearly that's sort of a more extreme example of it. But one thing I do know to be true is that the trend for self-directing investing is real and it's global. So increasingly around the world, what we're seeing is more people taking more control over their investing. And when it comes to things like levered ETFs or higher risk strategies, we're seeing more of that in terms of satellite investors. So people might have a core position of long-term S&P 500 or balanced portfolio of something, but are choosing to do the self-directed more and more themselves and are becoming more and more active, and therefore looking to take risk in that sort of bucket of the portfolio. And that trend definitely is global and it's growing.
What would you say? I guess the second toughest question I might have is, I've written and talked about the relatively meaningful body of academic evidence showing how much day traders tend to underperform the market. Day trading is not for most people. And for example, in Taiwan, 90% of day traders lose money, not just underperform the market, but actually lose. Your product is for day traders. I mean, is it something that's good for humanity? I would ask, because it certainly maybe adds some liquidity to the financial system, but is that overcompensated for by added volatility?
So, look, I think first and foremost, a lot of these surveys I'm not necessarily in agreement with. I think that a lot of people, the surveys come from uh, players that want to show a particular outcome. So
Well, I
want
think
to
this was an
show,
academic paper where they probably had the
yeah,
broker
exactly.
opened up their kimono, so not so much a survey, but a review of the accounts.
Yeah, and it obviously will depend on the length of time people hold, what they do. It will depend on a number of different factors. But fundamentally, I think that this is about giving people the freedom to make their own decisions. And this is about providing investors choice. And in terms of what leveraged ETFs really are, it's institutional price leverage to the masses. It's disruption of the traditional margin infrastructure. It's giving people access to leverage at a cheaper, more effective price and level of convenience than they've ever had before. And so, yes, there are clearly benefits to that, and those benefits are obvious in the sense that you can buy an ETF that gives you 2x the price of Nvidia over a given day. The cost of doing that is virtually nothing. But the flip side is, of course, that when you do anything that's leveraged, you're adding more risk into the equation, and therefore your potential for losses are also amplified. But we're dealing with at the core a community of people who love the stock market and who love to trade. And these type of products, while there'll be days of gains and days of losses, this is what really enthuses people. And just look at the volume on the platform. $1.5, $2 billion a day and growing kind of all the time. And that is telling you that this is a product that people love. And where you have live streams of retail investors on a Sunday afternoon, we get thousands of people all enthused about investing and stock trading. It shows you that that's their passion. And when people are passionate about something, they'll use it to the best of their ability.
It's kind of like a margin loan without the high interest rate. You might argue, I guess, in
Well,
that point.
and without the margin call, which is how a lot of people get wrecked with traditional leverage, is that the margin call that the broker makes on them is what actually causes the loss in the trade. It's not necessarily that they're directionally wrong. And levered ETFs don't get margin calls. There's no need for anybody to be called away. It's an embedded margin product if you want to look at it like that. You just buy, you're in control of it, not the broker.
Yep, and I guess people go to casinos. People do a lot of things with their money that sometimes give big payoffs and sometimes don't. That's their choice. Shifting gears entirely, though, philosophically, do we have too many ETFs in this world? And if not, at what number will we have too many?
So I'm a big free markets person. So philosophically, I believe in giving people choice and letting the market dictate what's popular, what's not. People have been saying this for 20 years, that we had too many, not just ETFs, but too many financial products. And on one hand, that may be true. But if it's true, then why do we keep seeing more and more demand? And again, if you're a believer in free markets, let the market decide when people have had enough. And that surely, in the case of, say, launching new ETFs, will be dictated by, is the ETF getting any traction or not? Is anybody investing in it? So long as people are investing in funds and the industry is growing, then there will be more product development, there'll be more innovation, there'll be more products that cater to that demand. I think also the challenge with that question is it sort of implies the market environment, the market dynamic is static, and it's never static. Mm-hmm. So right now, an example that has nothing to do with leveraged ETFs, but we're about to go into an easing cycle. And so we're about to go into an environment where interest rates are falling, not rising or staying at these elevated levels. So that will bring a whole host of new products in that environment, or to tailor their needs to that new environment, where people might want to protect high levels of income or high levels of yield before it goes down, or invariably if rates get cut and economic conditions change, there may be new strategies that will be needed to introduce to benefit people at that particular time. So the market's always moving, it's always dynamic. and so is the product creation and the innovation that goes along with it.
Just like how a language has many words that people can use to express how they feel or what they think, you could argue a marketplace should have many products or mechanisms by which investors could express their beliefs on an asset, whether that's an option, an ETF, some complicated fund, whatever it is, right? So that makes sense.
Yeah, absolutely. And language is evolving all the time as well. Say words now that didn't exist 10 years ago. And so it's evolving according to culture, taste, and it's no different to anything really. It's a living, breathing organism.
In terms of the actual ETFs you've got, if I double click on that, can you walk us through? It looks like the Nvidia is the most popular. What else is hot? You got like an like a BDC, REIT, MLP, kind of a high yielder one, a gold one. How would you describe it now, and where do you see the likely evolution going? We are going into an easing cycle. We've had arguably 13 years of great market performance, and maybe it's going to be a little bit more flat, some people say. Where are you steering your product portfolio?
Yeah, so we talked about the leveraged funds, but clearly we're more than just leveraged funds. And in the non-leveraged fund category, we have everything from commodities to equities and to income. And it's actually on our income side, HIPS is the ETF HIPS, which yields about 10% per annum, just a little bit over. That's a product which I think is getting more attention at the moment because of this concept of interest rates about to fall, and people that are getting used to 5% in treasuries or in a money market fund might see that go to 3%, something like that, the next 12 to 15 months. And therefore, people are looking to try and preserve that yield or that income that they're getting at the moment. And so that will mean people will have to move out of the risk curve or on the risk curve to obtain more yield, but also want to kind of lock into products, and HIPS enables you to do that because it has a fixed cash distribution. So we're definitely seeing more interest in income, seeing more interest in gold as gold hits new all-time highs, almost seeing on a daily basis as people look to potentially hedge themselves against a drop in the market. And then in terms of traditional equity investments, people are still leaning into the growth investments, AI, other sort of themes, but innovation kind of as its core. And we see interest from that side in our DRUP or DRUP ETF, which focuses on disruption.
Interesting. It was someone who ran a dividend stock research service for 10 years. I'm slightly partial to HIPS. I'm going to take a look at that more. I did notice, Will, though, it has a 1.99% expense fee ratio, if I'm not recalling, not recalling correctly, or if I am recalling correctly, I should say. What do you say to someone who is new and Googling again about ETFs and says, watch the fees, watch the fees, watch the fees? That's very common ETF advice. Then they may go to NerdWallet, which says the average leveraged ETF expense ratio is, I think, 0.96%. And just by some simple math, yours, I think, is 1.15% of your just your leveraged ones, using a simple average. Yeah. Is that a concern, or does it not really matter because they're in these just for one day at a time?
Well, there are two things. So on the leverage side, the fees are 99. It's just that the majority of these websites report the total expense ratio. So the management fees are 99 basis points, and there's an additional sort of 15 basis points that the fund can incur in terms of expenses. And that's like trading expenses, etc. So the actual investor's paying 99 basis points for that. In terms of HIPS, that's a great question because the total expense ratio is 1.99%. And people may think, wow, that's incredibly high. And that goes to the uniqueness of the product, where the majority of that, again, management fees wise, is 70 basis points, which is very inexpensive for a product that delivers that kind of yield. But like everything in a highly regulated environment here, we have to disclose all the fees, and the majority of the extra fee comes in the shape of what's called acquired fund fees and expenses, or AFFE. And this is a unique way that the regulator has for disclosing BDC fees. So BDCs, they really act like companies, so more like corporations, but they're taxed like mutual funds. So they're taxed as registered investment companies. And therefore, because of that, they disclose fees in the same way as registered investment companies. So that's why if you look at a BDC, And this is outside of the HIPS fund. If you look at a BDC, you might see an expense ratio of 5% in that stock price. Now, that's just because of the way that the fees get disclosed. So anybody that invests in BDCs knows that this is just a factor, or in other words, it's included in the stock price, and that you're not paying 2% to own the product. You're paying the management fee, but it's just that the expenses, the way that they're disclosed, is unique to BDCs. But definitely a good sort of thing that people need to be aware of whenever they come to invest in BDCs, that it will look like sticker shock, but it's just a disclosure. It's not actually
Not quite what it seems. Yeah, I'm glad you clarified that. Thank you. This may be too soon to call, but if you fast forward your business 5 years, are you still mostly a leveraged ETF company, gotten into other things, or too soon to know?
Unless something dramatically different changes, and again, clearly the market environment is always changing. I think that the natural evolution is where the customer wants us to be. So, if that means that leveraged ETFs continue to get more popular, like they are at the moment, and that's gone from nothing to be multi-billion dollars and trading like crazy all over the world. If that continues, then there's no doubt that we'll continue to give customers access to products that they love. We just launched Palantir just before they were admitted into the S&P 500. So that's an example of where clearly it's more luck than judgment, but you can bring out the right product at the right time. And with that inclusion into the S&P 500, and now the sort of new heightened awareness of that stock, with all the buying that the index funds, etc., have to do, it's performed very well so far. So we'll always try and meet whatever the market demand is, and so long as brokers and customers are asking for more of these products, and it will go in different directions. There'll be different permutations of it with income or other things, but we always have to kind of go where the demand is.
I may be new to leveraged ETFs, but my guess is that leveraged ETF investors, the core group, they self-identify pretty well. They know who they are. And if some of those folks are watching this, Will, and they'd like to find out more about GraniteShares, about the company, about some of your ETF products, where would you send them?
GraniteShares.com is always the best resource, and as it is for any ETF issuer, the issuer's website is where you get the sort of most accurate information, or at least the most complete information. People should reach out to us directly if they have any questions on any of the products. But GraniteShares.com is definitely the place to go.
Great. We'll put up a link on the screen, and I'll put that in the show notes as well, so they can go check it out. Will, you've been very generous with your time and with your knowledge, and I appreciate you fielding some of those tough questions and got good answers from that. So thank you so much. And thanks to you guys, as always, for watching us at home.